Okay, this is the 2-hour opening range trading strategy. So let's go over the basic things that you need to know for the strategy first. Indicators, you don't need any. I do have an indicator on the chart that automatically shows me the range of the opening 2 hours, but you certainly do not need any. You will want to use the fib tool to draw in a level. So no matter what trading platform you use, you should have a fib tool, and you just need the 50% level. If you are looking for the opening range indicator that I have here on NinjaTrader, it's just called Open Range. There are ones on, I'm sure, every platform. You just need an opening range indicator, and then you set it to 2 hours, starting from 8:30 Central and going through 10:30 Central. Risk, we're talking about prop accounts here. If you have trailing drawdown, 10 to 15% of trailing drawdown, that's per day. In fact, it's per trade. May seem like a lot, but you're going to use micros, so it should be very difficult to hit that. If you have end of day drawdown in a prop account, 20% of your daily drawdown, perhaps up to 25%. Target on each trade, you're going to use a trailing stop. Once it starts going in your direction, you just use a trailing stop and try to capture as much as you can. Okay, now that that's out of the way, how does the strategy work? So you're going to wait for the first 2 hours to form, and then you're going to look for a situation where you have a range. If the market is trended for the first 2 hours, this is not a strategy that we're going to be able to use. Fortunately, most of the time during those first 2 hours, the market ranges. So how do we objectively define range? You want to have swings in both directions being broken. So we have swing high, broken, swing low, broken, swing high, low, broken, swing low, broken, swing high, broken, swing low, broken, swing high, broken, swing low, broken. So we have a range. So what do you do in a range? How do you make money? You sell high and you buy low. So we're going to take our fib tool, draw from the low to the high, find our 50% level. It's the only level we care about. We want to be a seller above that level and a buyer below that level. Where specifically do we want to sell? If we are above 50%, we want to sell at or above swing highs. If we're below, we want to sell at or below swing lows. It's best to use confirmed swings. What is a confirmed swing? Confirmed swing is this level, not this level. You may intuitively understand the difference, but just in case you do not, if we're looking at a low, the confirmed swing low is the lowest point between two highs. So we have this high and this high. So is this a swing low? No, that's not the lowest point between them. This is. So that is the best place to enter. So if that's what you're here for, just that strategy, that's basically all you need to know. However, I'll add a quick caveat that you want to see price action prior to your entering into a trade. You want to see that previous swings are overlapping. In other words, we have this high, this low, this high. What happens after that is price overlap with this swing. So this swing takes up this entire distance. So once price breaks above this level here, once price breaks above this level here, does price overlap with this swing? And yes, the answer is yes, it does. If it did not overlap, we wouldn't be super interested. So we want to see swings overlapping. So now we'll kind of get into the nuance by showing you some examples. All right, so our first opportunity after this 2-hour window is over comes right here. At our confirmed swing low, we enter long. Where's our stop? We don't really have a stop. Our stop is 125 points away if this is a $50,000 account, because that would be $250. You don't have to risk that much, but that is probably the best way to do it. You could change that figure to anything that you want. $50, $100, doesn't really matter. And where is your target? Well, you're just going to trail a stop. So one thing you could do is once market starts to move in your favor, we have a bull bar, we could trail our stop below this bar, trail our stop below this bar, trail our stop below this bar, below this bar. below this bear bar, and then we're hit and taken out right there. That's one way to do it. If you're on a lower time frame, potentially you could have been trailing it a little bit tighter, but probably you would have been stopped out earlier. Let's look at some more examples here. So this swing level comes above the 50% level. Now, technically, the confirmed swing high between this low and this low is all the way up here. That's quite a long distance away. This level technically is a confirmed swing high. So we also could have actually taken a trade short at this level. We're going to get into some nuance real quick here as far as price action signals. Some of you may be asking, should I wait for a signal bar before I get in? What is a signal bar? A bar, it's any bar that you choose to to use as a signal that you should enter the trade. And typically with signal bar, you'd place your stop outside of that signal bar. So let's say we wanted to use this bar here as our signal bar to go short. Meaning we're just waiting for price to come to our level, seeing some kind of a reaction. In other words, it's not a big bullish candle that forms through here. So we have something happen. So doji, maybe that's a good indication that the market's going to reverse. All right, and then we sell one tick below that and put our stop above it. You can do that, but sometimes what will happen is you will get the signal that you want, and then the market will come and take your stop out. So if we look here, if we would have entered at this level, market would have moved up in our favor about 10 points. And we could have placed our stop below this bar, and then we would have been stopped out. We wouldn't have made any money, but we wouldn't have lost any money on that one. Had we waited for this signal bar and bought at the close of this bull trend bar, then we would have actually lost money. So it's a toss-up. Signal bars don't always result in movement. A big strong bull bar does not mean the market's going to reverse there. It just doesn't. Does it increase the chances? No, actually not really. You may disagree with me, and if you do, that's fine. Do whatever you want. This is just how my strategy works and how I prefer to trade it. So technically the best level to enter here, you can use this one because it's the lowest point between two highs, would actually be this level here. So we could be entering long there. Now it continues against us, and if we want, if we can afford it, if we're trading small enough, we can enter again down here. Some might think this is bad because you're averaging into a losing trade or adding to a losing trade. We are not. We're campaigning around a position. The market's ranging and we're entering the market. We don't know where it's going to turn around, but we know probably, because the market has been ranging today, that we know that probably it's going to turn around. We don't know exactly where, so we're entering into the position and bring our average down. Depending on the size of your account, you do have to be careful with this, so manage risk appropriately. But you can see that all of these entries, this one would have been better, and this one obviously would have been best. We obviously had an opportunity to make profit here. Now, if we trail our stop by only one bar here, well, first we have to get into profit. So we're in profit on this bar at the close of this bar. If we trail our stop beneath this, we're not in profit yet, so probably we wouldn't want to be trailing there yet. Now we're in profit as of the close of this bar, so we can trail our stop below there, below there, below there, below there, below there. It's quite a lot of money for this last entry. Let's say the worst one here. 14 points, not a terrible amount of money on a micro, $28, but if we've been averaging into it, would have had 3 positions on with an average price around here. So that'd be about 15 points times 3, so that's $30 times 3, so that's about $90 in that specific case. So I want to continue and move forward in the chart and find a situation where things are a little bit more difficult. It would have been a little bit more difficult to make money, or even impossible, and talk about why we would not want to be entering mean reversion in this situation. All right, so the market definitely was ranging before it opened, or before our trading window opened anyway. But why might we not want to? So our trading window begins on this candle here, and we see that the most recent swing high is right there. We're clearly above the 50% level. So why would we maybe not want to sell this level? Well, we want to take a look at what has been happening prior to this. So we obviously don't know what happens after at this point, right? But what's been happening before? Should I enter into this trade if the market comes up to this level? Well, let's look at the swings that have happened on the way up. We see gaps between these swings. Swing gaps are called. In other words, price is not really overlapping between these pullbacks. Price goes up, it pulls back, goes up, pulls back, and it doesn't even pull back into the range of the previous swing. So you could just ask yourself, if I was shorting these highs on the way up, would I have been making money? And the answer is clearly no. Maybe would have had a chance to get out near break even on this trade. Maybe could have gotten a couple of points on this trade. Maybe also could have gotten a couple of points on this trade. So we want to expect that whatever the market is doing right now, it's going to continue doing until we see evidence to the contrary. So until we see swings are overlapping each other, we don't want to be selling highs. So here's our swing. Comes back here again, not really an opportunity to make profit there. So do we want to sell this high? Again, so far we haven't seen an opportunity to make profit. Do we want to sell this high? Nope, this swing did not overlap. This one did not overlap with this one. So we don't want to sell this high. Now as we move down, we see the same situation. These swings are not overlapping each other. So do we want to buy below here? We don't know what happens afterwards yet. Do we, based on what we know now, want to buy below this swing? No, because look at how much the market traveled, the distance that the market traveled between these swings. So we're going to expect that it's probably going to continue that way. We'll talk about how to handle this in another video, maybe how we can trade in situations like these. But that's not the point of this strategy. This strategy, you want to look for a range. You want to look for overlapping swings. You want to sell highs above the 50% level and buy lows below the 50% level. That's it.